Welcome to Tax-Free Compounding, the most powerful force in investing and how to achieve it with private placement life insurance, sponsored by Peak Trust Company. Speaking today is Jonathan Blattmachr of Pioneer Wealth Partners in New York, New York. Matthew Blattmachr of Peak Trust Company in Anchorage, Alaska, and William Lipkind of Wilson Elser in Madison, New Jersey.
Well, Robin, thank you very much. This is Jonathan Blattmachr, and it's an honor for me to be on this program with Bill Lipkind, who is one of the most extraordinary lawyers I know, one of the most practical ones, a Harvard Law School graduate, and I've had the privilege of working with Bill many times. And also to do it with my nephew, Matthew Blattmachr, who is the CEO of Peak Trust Company in Anchorage. And I hope you will find this to be a very, very important webinar for you to listen to. Let me go to one of our slides here. I said that there are three physicists who lead this way for us. So one is Albert Einstein, and of course, he's famous for the statement E equals MC squared, whatever that means. I know it means that that's how we get a lot of power, but I really don't understand it. He also said a couple of things I do understand, and one is that compounding is the eighth wonder of the world, and we're going to go through that and point out why that's so important in building and in maintaining wealth. Albert also said the hardest thing in the world to understand is the income tax, and the corollary I derive from those last two statements is that tax-free compounding is the most important aspect of successful investing. Now, it's just absolutely true. I mean, I've got some numbers here, but I want you to take a look at a couple. One is whether or not you compound. And before 1900, compounding, which is to pay interest on interest, didn't seem very important and rarely was offered. But if you take $100 and you earn 5% a year, which would be $5 each year, you don't compound, it means you're going to earn $5 each year. So in 10 years, you're going to have 5 times 10 or $50 of interest. So your total amount would be $150. In 40 years, where you've earned that $5 on your 100 without compounding, you're going to have a total of $300. That's simply the 100 you started with and the $5 a year for 40 years. If you go down to, say, 10% without compounding, it grows to 210 years and 540 years. That's just because you're earning more interest and you're adding it up. But when you compound, you get something extraordinary going. That's the interest on interest. So if you take a look at the last item here, with our $100 where we earn 10% a year, but it compounds, it grows to $259 in 10 years and 4,540 years. In other words, 9 times more. Really extraordinary. The corollaries which we derive are that the longer the term, the greater the effect of compounding. It's not just adding more, it's the compounding effect. It's the interest on the interest. And the higher the interest rate, the greater the relative increase in compounding. I mean, it's just extraordinary. Again, let me go back one slide here. And again, take a look. You know, we looked here, we get to 300, or we get to 704, or we get to 500. But if we get 10% compounded for 40 years, we go from $100 to 45 times more, to 9 times more than if we hadn't had it. And that's just extraordinary. And it shows the kind of wealth you can get. And it means you want to start saving early in life. Let's take a look at this slide right here, simple versus compounded interest. You'll notice that the one at the bottom in the light blue is 5% simple interest, and that's our $100, which grew at 5% non-compounded, just simple interest. And, you know, we get, you know, as I said before, we grow to $300 in 40 years. If we get 10% simple, we get more. We get about $700. And you'll notice that 5% compounded doesn't exceed it, but it does in the early years. If you go back, for example, to year 20, you'll see that the gray line, which is the 5% compounded growth, is actually greater than 10% simple growth. But again, take a look at that 10% compounded growth line. That's where you want to be. That's where we get to that 4,500, just starting with $100 and we go to 4,500. So in your working lifetime, you want to start saving early and you want to try to get a high return and to have it grow tax-free. Because if we take a look at what taxation does to us, if we earn, say, 6% annually, each dollar grows to $2.65 in 20 years. But if we have to pay a 20% annual income tax, we don't have $2.65 anymore, we have $2.19. So we've suffered a 17% reduction in wealth over 20 years because we had to pay an annual 20% income tax. At 10%, we go from our $100 to $673 without tax, but only $466 with tax, or a 31% reduction. Go over to 30. Each dollar grows to $190. Think about that. You start with $1 and it grows to $190 in 20 years, which would be phenomenal. But if you pay tax at 20% each year, you only grow to $73.86, which is a 61% reduction on account of taxation. And what that means is the higher the return, the more the return is eroded by current taxation. And so we don't want current taxation. We want to postpone it or, if possible, completely avoid it. Here it is in graph form, for example. Here we have a 17% reduction on the left. That's where we have 5% annual return and a 20% income tax on that return. At 10%, there's our 31% reduction. And instead of getting $673, if we didn't pay tax, we only get $466. At 20%, our $1 grows to $38.34 over a term of 20 years. Think about that. $1 to $38 over a period of 20 years if we get a 20% return. But if we have to pay an annual income tax, we lose about half of it, so we only have $19.46. And take a look at what happens if you get a 30% return. Our $1 grows to $190. I mean, talk about an extraordinary effect of compounding. I mean, $1 to $190 in 20 years because we made 30% a year, but if we have to pay an annual 20% income tax, we only have $73.86. That's still an awful lot of money, but only about 40% of what we'd have if we could have avoided the taxation. Now, how do we reduce the impact of income tax? Well, you can do a buy and hold strategy. So you just buy some stocks or whatever you're getting and you don't sell it, you don't pay that, and you hold it, and then you wait for the tax-free step-up under Section 1014 of the Internal Revenue Code when you die. You could also buy municipal bonds, but municipal bonds aren't really tax-free. They're really pre-tax. The return you'll get on a municipal bond is approximately the same that you would get with a taxable bond, but you get a lower rate of return. IRAs also provide a deferral of taxation. And one of the problems with an IRA is, at least the IRS has indicated, you can't avoid estate tax on your qualified plan. There have been articles which say you can, but the IRS unofficially has said you can't. And a couple of people I know have tried to get rulings from the IRS, and they simply won't rule that you can get an IRA out of your estate and keep it as a qualified retirement plan. Roth IRA, yes, you can do a Roth IRA, but you set aside less money on it. You do get the estate tax advantage isn't there because that also means you can't do it. The wise old accountant's adage is, a tax dollar delayed may never be paid, and that's true today with the tax-free step-up in basis. Can you do it with a charitable remainder trust? Well, remember The income earned by a charitable remainder trust is not subject to current taxation, but as distributions come out of the charitable remainder trust, it will be subject to tax. You can retain only 90% of the current value in it, but if you say, well, I can either sell this piece of property and pay a 20%, let's say, long-term capital gains tax rate, we're left with 80%. If you have a well-structured charitable remainder trust, you can retain 90%. Now, the comparison isn't perfect between a charitable remainder trust and just selling the property when you want to, because of the type of income and the inflexibility you have with a charitable remainder trust. Life insurance. This is probably the best and safest tax shelter of all. It is probably the most misunderstood financial product out there. Now, life insurance has two components typically. It has, just like most of the insurance you have, your car insurance, your fire insurance, your malpractice insurance, you pay the insurance company a premium each year. And if the event you don't want to happen, you don't want a car accident, you don't want your house to be burned down, you don't want to be sued by someone, you get basically coverage. If the bad event you don't want to happen occurs, the insurance company will pay. But if you don't have, a flood in your home, you don't have a fire, you don't have an accident with your car, the insurance company keeps the premium and you get nothing back. But life insurance is different because for tax purposes, you get that, basically that net amount at risk. It's called the net amount at risk because that's the amount for which the insurance company is liable if the event you don't want to happen, like your death, occurs. So if you don't die for the year you have the insurance company keeps it all. But the insurance industry was very clever, and it convinced the federal government, and in particular the Internal Revenue Service, to treat also an investment component as part of the insurance product. So when you get something, and you might call it whole life insurance or something like that, you not only get that risk of insurance where the insurance company will dig into its own pocket in order to pay the claim if you die, but it also has basically an investment account. And those two things together make up most modern insurance policies. A term policy only has the term component. If you die, you get paid. If you don't, the insurance company keeps the premium. But why wouldn't I want to do that? Why would I want to have this investment component? The reason is, as you age, the cost of that risk premium will go up enormously. And once you get above the age of 80, it's just about impossible to maintain a pure term life insurance policy. By the way, term means it's insurance for a limited period of time for a term. Now, a lot of people say, I don't believe in life insurance. I think the answer is you don't understand life insurance, because the best attribute of life insurance is that the component that's basically the investment account grows entirely tax-free. Whether you get what would be ordinary income or capital gain, it all bills tax-free. And when the insured dies, in almost all circumstances, the money paid will be tax-free. So it's a true tax-free return. Well, why doesn't everybody then buy life insurance to make their investments? Well, there are a number of reasons. One is this cost. You have that real term cost, the net amount at risk cost. There are fees, in fact, there are hidden fees, and there are taxes. States and the federal government impose taxes. It's also complex, and there are limitations as to what you can do, which are built into the Internal Revenue Code. But I think the main reason it's not done is a lack of understanding. Now, the solution for some people is private placement life insurance. Private placement life insurance, and Bill Lipkind is going to take us through that, is different than just pure term insurance. There's SEC regulation, or could be. You get wholesale premiums for the net amount at risk, and you have flexibility investments. The Internal Revenue Code, and there are other rules that apply, which have to be considered, or you really won't have the benefits of that tax-free buildup in life insurance. There are capacity and complexities. Is the cost worth the effort? Well, it depends on your point of view. But here's the key. Here's my formula. You take the anticipated cost of the insurance in basis points, like say 100 basis points. you divide it by the annual income tax rate, also in terms of basis points. And that component, that quotient, must be better than the anticipated annual return. Let's take an example. The anticipated annual cost is divided by the anticipated annual return. Let's say the anticipated annual cost is 10 basis points. The anticipated annual income tax rate on your investment would be 40 basis points, 40%. That equals the minimum threshold. In other words, 100 divided by 40, or 2.5, is the minimum rate you have to expect to earn on your investment in order to even consider it. So if this is it and you say, well, I think I may only make 2.5% a year, definitely private placement life insurance is not for you. But let's take our next example. Hedge fund anticipated annual return is 9%. Anticipated annual income tax is 45%. The net after-tax return has to be 4.95%. If it doesn't, again, this is not something for you. So you need to do that. So you've got to anticipate what the annual return is and what you'll get. Again, the moral, the higher the return and the higher the tax rate, the more powerful private placement chassis becomes. Here's a chart I put together. This blue line is tax-free compounding. The annual taxable compounding is just the yellow. And if you don't get compounding, which is the way it was before 1900, you're at the red line. You want to ride the blue line every single time. One question you can ask your investment advisor is, how much more could you earn from me if I were tax exempt? And every time I've spoken to an advisor, they say, yeah, I can earn more, but I don't want to express what that would be. Try to get them to return it. Conclusions, tax-free compounding is probably the most important factor in investing. The higher the return, the more important compounding is. In other words, it's not additional, but it grows at a great rate. The greater the return, the greater the drag of current income taxation is on the yield. Tax-free compounding is available for private placement insurance, but the details are complicated. Now, the final is, it might be possible to achieve 30% return on average, which will make tax avoidance even more important. So, Bill Lipkind, would you please continue?
Thank you, Jonathan. The slideshow has a lot of material. There's discussion of risk factors for those who are interested. Indulge. There are references to various private letter rulings and revenue rulings. There's some great articles by a couple of my favorite authors. Before getting into the nuts and bolts, Jonathan is not the only person in the country who's aware of the consequence of compounding with private placement. Senator Wyden in California is aware of it, and he abhors it. He's been an advocate that it should be terminated legislatively. He plans to introduce legislation into the Senate. President Biden included the death knell of private placement in his budget for 25. So, a lot may turn on what happens on November 5th. If from a private placement point of view, it's the end of the world, you want to get things done this calendar year. The odds are it won't be the end of the world, but that the fact that Jonathan is not the only person who knows about the value of compounding is just a factor to take into consideration. As Jonathan pointed out on the basics of life insurance, cash value life insurance, you have an investment bucket, you have a risk bucket. The cash value can grow without taxation. That's the magic of compounding. Section 101 of the Internal Revenue Code says that the death benefit is estate tax-free, and there's a fair amount of asset protection in the entire arrangement. How does variable life insurance differ? Well, if I buy a $10,000 policy, whether the insurance company is successful or not in investing the investment bucket, I'm going to get, my beneficiaries will get $10,000 when I die. So the insurance industry said, well, we ought to have a product that if the investment is successful, it will grow in the death benefit. That's a variable product. The SEC says that the marketing of variable products is the sale of a security, hence the major insurance companies all have S-1s. They file with the SEC to produce it. Wherever there is a public offering, there's a private placement, hence the phrase private placement. And obviously, if you have a net worth of 50 cents, you're not eligible. But if you have a meaningful net worth, you are eligible. Theoretically, when you have private placement variable insurance, you can negotiate with the insurance company and push down the cost, the commissions, the cost, the annual fees. You can select, and we're going to talk about this in a few minutes, how the money gets invested. So the incentive here is that if I can select certain aspects of the investments, or the genius who will do the investing, and I can keep the fees down, won't the compounding without any federal or state taxes be marvelous? And the answer is Jonathan yelling, yes, it will be. It will be. There are three statutory definitions that we care about, and we'll talk about that in a couple of minutes. I just have them listed there under item 2, the definition of an insurance product, which is 7702A, the diversification, and the segregated asset account. We're going to talk about that. I'm trying to get through these preliminary things because I would like to spend the bulk of my time on our practice and how we deal with certain of the issues and problems that it may not just be a simple check-the-box way of handling it. There are three major categories in the uses of private placement. You can take cash and make an investment. And if you invested in something good, you can look at Jonathan's slides. That type of an investment can present the least amount of risk factor. The next thing that you think about is that, well, if the taxpayer has invested in some non-public company, some venture interest, and he thinks it may only be worth 52 cents today, but someday it could be worth 520 cents. If I can get it into a policy now with a low value, that means all the gain will escape taxation. That has an increased risk factor we'll talk about. And finally, just to round out the different uses, the entrepreneur with a business says if I can get my company or a piece of my company into a policy, that means when I sell out for $1 gazillion, I'm going to save a lot of money and then reinvest it tax-free. Let me spend some time on the four major risk factors I have under item 4. Section 7702A is a definition of a life insurance contract. That is not for any of us to figure out. That the insurance company will provide it. They should be able to certify it. You will find experts who can tell you whether you've met the definition or not. That should not be a risk factor other than having someone mess it up. You should also want to avoid being a modified endowment contract, which is covered in 7702 capital A, because if you borrow from a modified endowment contract, you have an income tax consequence, which you don't have. If you have a life insurance contract and it is not a modified endowment contract, the jargon being non-MEC, then borrowing is tax-free. So that's something you would want. Section 817 is the section of the Internal Revenue Code that talks about variable products. The best known requirement is that it requires diversification. And their regulations go on at length. For example, no one investment can exceed 55% of aggregate investments. No two, 70%, 3, 80, 4, 90. Once you've made the investment, that can grow. There's no end to how high is up, but that can grow, and that is never a problem. If you have an investment that has grown tremendously, and then you want to put more cash into that investment, now you have to comply with diversification. What happens if you fail to meet diversification? That sends you over to Section 7702, which tells you that all increase in cash value is going to be subject to payment of income taxes by the owner of the policy, not the insurance company. So you want to meet diversification. Your insurance company should be able to monitor that. Whoever is running the money, and we're going to talk about how that gets done in a few minutes, should be able to monitor that. There, in most cases, is no excuse for not meeting diversification, but nonetheless, there you are. In the first year of a policy, you have a whole year to meet the definition. One solution. Oh, and by the by, if you mess up with diversification, this is Humpty Dumpty falling down. Can't put it back together again. There isn't a matter of, oh my goodness, we missed it this quarter, please forgive us and we'll go ahead. No, you're finished forever. So this is one strike and you're out. In some cases where there may be some uncertainty, there's something called a frozen value policy, so that if you write if the insurance company writes a policy and says there simply is no cash surrender value, it's a death benefit or nothing, then you don't have a diversification problem. That may be a solution that isn't very appealing to people. If you're 35 years old and you're thinking about Mr. Blattmachr's graph, which is going to tell you how much it's going to grow in 50 years, to be told that you can't borrow any money for 50 years, but if you die, your children will be rich, is not a very warm and cuddly sort of thought. So you want to be able to borrow. It's standard life insurance. If it isn't a non-nec, you can borrow. Section 817 also provides that you have to have a segregated asset account, and this is worth considering in some detail. Domestically, all the insurance companies qualify so that no creditor of the insurance company can get its hands on your money in your policy. Those investments are immune from insurance company creditors. They're immune from creditors from other policies. It's not part of the insurance company's general account. But that result that has to be achieved under, and I have in quotation marks the provision of the code, says state law or regulation. As we're about to find out, certain types of policies, I have to go offshore in order to get the policy issued. Let's assume you found an insurance company in the Turks and Caicos, just to pick a place offshore. Turks and Caicos is not part of the United States. The word state, capitalized, defined in the Internal Revenue Code, refers to the 50 states plus the District of Columbia. Well, how do offshore insurance companies deal with that? There's a provision in the Internal Revenue Code, 953D, that permits a foreign insurance company to elect to be taxed as a U.S. corporation. I'm aware of at least 3 private letter rulings that say for offshore insurance companies that have made the 953D election, we will treat their country as a state. For example, I'm aware of at least one Bermuda-based insurance company that has such a private letter ruling. So for purposes of of insurance, Bermuda is a state to meet their requirement. When you start to ask various offshore insurance carriers, do you have a private letter ruling, you'll find that the vast bulk say no. Some have opinions of counsel from major law firms because you have the applicable legislation in the country, they've made the 953D election, and the insurance company is relying on the opinion of counsel. And then we've run into offshore carriers that just ignore the whole issue. Now, I think you have a problem because Internal Revenue could take the position that it simply is not a segregated asset account, and therefore it doesn't qualify as a variable policy, and therefore all of the income in that policy is taxable to the owner of the policy, not to the insurance company. So in dealing with a offshore insurance company, it is our practice that we simply won't do a private placement policy with a company that has not made the 953D election. Then it's up to the client whether they want to do it with or without the private letter ruling from that insurance company. So that's something to be sensitive to. It's not a widely circulated problem. We've been mentioning statutory requirements, 7702, 817. There is one requirement on private placement that is not in the code. There's no regulation on this. There is no fixed definition. That's called owner control. In your slideshow, you'll see quite a number of slides devoted to the topic. References to private letter rulings, references to revenue rulings. When you get past all of the discussion, the premise, the platform upon which this doctrine rests is the 1940 decision of Halvoring v. Clifford, Supreme Court of the United States. That was a case that did not involve insurance, but involved the trust before people were filing joint tax returns. Husband set up a trust. His wife was a discretionary beneficiary of the income. 5 years later, it all comes back to him, but it'll give her the accumulated income, and he's running the money. Supreme Court said, in a very readable opinion, where the taxpayer, in this case was the husband, has an ongoing control of the investments, and in addition, has maintained substantial beneficial enjoyment of the assets, he should be the taxpayer, not, in that case, the trust. In the Weber case, you'll see that Mr. Weber was the beneficiary of a grantor trust. Court said, well, if it's a grantor trust, he's deemed to own it, so therefore he's a beneficiary, even though he never received a penny. And he had communication back and forth with the people running the policy. He put assets in, borrowed money out. He treated it as the court said, his own piggy bank. And they said, you fail the test. All of the earnings in the account are taxable to Mr. Weber, not to the insurance company. So the basic issue becomes in private placement, am I at risk for owner control? When you go through the rulings and cases, the universe divides into two portions. One portion is referred to as IDFs, Insurance Dedicated Funds, and that's a fund that's available only to insurance products. That sitting here in my office in Madison, New Jersey, I can't invest in it. Only the insurance company. Jonathan can't invest in it. Matt can't invest in it. It's an insurance dedicated fund. Interestingly enough, what bothers Mr. Wyden the most out in California for private placement happens to be the compounding of value with insurance dedicated funds. Internal Revenue said if you do an IDF and you do it and it's done properly, you don't have an owner control problem. But the IDFs are not only restricted to insurance products in their structuring, they obey certain rules. And the basic rule is that the owner of the product can understand what the general strategy is. He can always ask questions as to how come last year we only earned 20% when everybody else earned 30%. He cannot participate in the selection of future investments. And those rules are reflected in the agreements between the insurance company and either the sponsor of the IDF or whoever is running the money. Some insurance companies will take whatever the person puts in there, put it into an LLC, and say it's an insurance dedicated fund. If their structure is such that it's not generally available to other insurance products, it's just only it's form and substance, and I don't think that's an IDF, although I'm not aware of any formal definition of what has to be included in an IDF, so it will be an IDF. There are certain sponsors of IDFs that promulgate a platform with a whole series of different IDFs that insurance companies can put onto their platforms, and the owner of a policy can select. If you have an IDF, you can go into an IDF, get rid of it, turn it to cash, do another IDF. It doesn't matter if you're the owner and you own the policy, you're not going to have a problem with the structure. So the safest thing to do is you put cash into a policy. It can be a domestic policy, and you invest in an IDF. You do that, and if it's a properly structured IDF with one of the major providers of it, your risk factor in the spirit of differential calculus should be a number approaching zero. Where it gets interesting is when you want to put in non-public assets or put in your own company. There are two ways in which the cash inside a policy get run. You can have a fund, that's the IDF, or you can have a particular person who will make the investments. That's referred to as an allocator. Many of the domestic insurance companies permit allocators in addition to having IDFs. If it's an individual allocator, then a couple of things flow from that. The allocator should be a registered investment advisor, shouldn't be your cousin. The agreement between the allocator, because the allocator is an employee of the insurance company and gets paid by the insurance company, albeit the cost is charged to the policy, can present you with a general strategy. There can be periodic meetings to look at how did we do. Well, here it is October. How did we do in Q2 of 24? But they cannot. You cannot discuss with them future investments. If The allocator cannot say, what do you think if we invest all of our money in fly by night? That's forbidden. I am not aware of any domestic insurance company that's going to accept as an investment anything other than cash. So if you have a non-public asset and you want to get it into your policy, I'm not aware of any domestic company that will let you do it. And to go further, if you want to put a piece of your own company in there, I'm not aware of any domestic company that will do it. The offshore companies, by and large, will do it. It doesn't change the risk factor that there is one on owner control. The risk increases when you're involved in the client putting in his own asset. We had a client who levered in stock in a company. He wasn't an employee, officer, or director, worth $6 million. Several years later, it got sold for well over $100 million. He was a happy puppy. But think back to the two prongs that I mentioned for owner control: continuity of control over the investments, continuity of beneficial interest. There are those who argue that if any premium is paid in kind, that's a violation of owner control. I am not aware of any authority, any promulgation by Internal Revenue that has sought to apply owner control where there isn't a continuity of beneficial interest. How we minimize these problems, I'm going to deal in Section 6 on the pragmatics. How do I fund the premium? Well, I'm going to probably have an insurance trust, an ILIT. I can make a gift of my premium to the ILIT. I can do a split dollar. If I'm going to make a premium payment in kind, putting aside owner control, that's a taxable event. If I have a basis of 1 and has a value of 10 and I contribute to the policy credits me with 10, I have $9 of income. That causes people to think in terms of installment sales, to defer some of the capital gains tax on that, or the use of derivatives with options. Spend the next 15 minutes on what I have under pragmatics, because there's a lot of fun in that. We've already sort of covered who is eligible to do this thing. If you're not worth much money, you're not going to be eligible. Some insurance companies will have a minimum premium investment of $2 million, $5 million, whatever. It could be substantial. I'm going to focus on the non-public assets. You need an appraisal. The appraisal is worthless if it isn't as of the fair market value on a date, approximately the date it goes into the policy. The appraiser, to make an appraisal worthwhile, has to be aware of all facts. So if you tell him, well, I paid $100 for this asset, and you don't bother telling him that the company is up for sale with 5 letters of intent at $1 million, that appraisal is worthless. So having a competent appraisal giving you the value is I understate when I say it's only important. It is crucial. And there cannot be that time delay between the appraisal and putting it in. Then I get to an insurance trust. You think about the insurance trust for estate tax. If I have an IDF, I don't care whether you have the estate tax benefit or not. If you want one, you've got to have the insurance trust, but I don't need it for owner control. But if I don't have an IDF and I'm concerned about owner control, now the insurance trust becomes very important for us. Remember I said that that the first prong on owner control is continuity of beneficial interest. So let me spend a couple of minutes giving you some of the substantive provisions we put into our ILITs to arguably minimize, presumably eliminate, because we've never had the IRS fight with us on this, beneficial interest. Number one, our client sets up the policy, and the only beneficiaries of the ILIT are his children, or his descendants, neither he nor his wife. We make it a non-grantor trust. Now, you're going to tell me that you can have a non-grantor trust where if you do it with Peak Trust Company, where you're a beneficiary, provided that an adverse party consents to a distribution to you. Maybe so, but not in the ILITs we do for private placement. So we say that the beneficiaries are the descendants. We say that not only is the grantor and the grantor spouse not a beneficiary, we have a whole provision that says that the trustee cannot lend money to the owner, to the grantor or his spouse, regardless of interest or security. We preclude the trustee of the ILIT from investing insurance proceeds into any company where the owner, the grantor, has a 5% or greater interest. And finally, while it's perfectly okay from Internal Revenue's point of view on estate taxes for the grantor of a trust to have the power to hire and fire independent trust fiduciaries, we require a corporate fiduciary, and we don't let the grantor do the hiring, firing. He can appoint a protector, someone who is not closely related to him, to make that decision. But we want a casual reader of this trust to conclude, with the insight of hindsight, the grantor has no beneficial interest. We know that the Internal Revenue Code has provisions for attribution. We are not aware of any common law of attribution. Put aside form over substance. We've had, in one case, this very form of insurance trust be subject to a matrimonial dispute. The wife divorces the husband, and her matrimonial attorney says, oh yeah, but this is really a matrimonial property and I should get half. And a matrimonial judge, who most matrimonial judges don't want to read about trusts and understanding that, said, no, it's for the children. I'm not going to give up the children's money for you. So we use the structure of the insurance trust as a fundamental means of trying to eliminate, certainly for argument's sake, we eliminate continuity of beneficial interest. If you have an allocator, we don't permit the allocator inside running the money inside a policy also to be handling the personal investments for the client outside the policy. If they did both, they would never convince me, let alone a tax court judge, that the client wanted, and therefore I have a risk factor that the client is exercising control over investments. True, I make the argument that if there's no continuity of beneficial interest, it doesn't matter if there's continuity over investment control, but it's better to have a defense on both prongs than trust only one. If you're putting in something other than cash and you're using an installment sale or an option, I've already mentioned valuation. It is possible, believe it or not, that on an audit, the IRS might disagree with the evaluation of the appraiser. Well, if you're doing estate planning, you think in terms of laundry provisions and other things. But what do we do here? My concern is that if the IRS says the asset is worth more, unlikely they'd say it's worth less. They're going to say, aha, you sold an asset worth $15 for $10. That extra $5 is sort of like a premium payment in kind. Not only is there an income tax going in there, but you blew out diversification, Humpty Dumpty had a big fall, and now you're taxed on everything. We build into an automatic increase in either the strike price for valuation or a final payment on installment sale to deal with IRS disagreements on valuation. But however you do it, it is certainly something you want to think about. How do I get dollars out of a policy? Well, it's like any other policy, any other cash value policy. If you're not a modified endowment contract, you can borrow income tax free, or when the insured dies, the money comes out tax free. That's the same as any other insurance. I'm going to talk at length about the opinion of counsel, but if you don't have an IDF and you're putting in an asset that's non-public, if it's a piece of the client's property, a client's own company, then there may be a stockholder agreement, there may be an operating agreement that restricts the ability to sell. It's advisable to think about that and get rid of it so that once the policy acquires the interest, you can't shove a sub-S company stock into a policy. So what you wind up doing is, if you have to get a sub-S company in there, you got to make it you can do a sub-SF reorg, which is basically making it into a subsidiary of another subchapter S, and then you can convert it to an LLC, tax-free, and get the LLC interest in there. Let me talk about reporting in the last few minutes and the opinion of counsel. We think it's important that when you set up the policy, again, I'm leaving IDFs to one side where you've put in cash. It's good to file a gift tax return and say, I have made no gift. That's a valuation issue. If there's an installment sale, you want to report it. If it's an option, the payment of the option price isn't taxable, at least until the option's either exercised or abandoned. But you want to consider whether you want to do an 8275. That's the form with the IRS, a disclosure form to spell out chapter and verse exactly what you've done so that the client would avoid penalties. I'm not saying we don't do that in every case, but it's something that should be thought about and discussed with the client. When in the Weber case, among the questions the judge asked, was there an opinion of counsel? Was an 8275 filed? If those are the sorts of questions the tax court judge is going to ask, you'd like to have answers that suit your results. It's our practice that we will not do a private placement policy structure if we're not willing to render an opinion. Not all the clients want to pay for one, but we have to be willing to do it. It's our own internal mechanism. Where we do an opinion, there are certain certifications, putting to one side, spelling out all of the facts, the entire history. We request certifications from the insurance company that cover things such as it meets 7702A, it meets the diversification of 817, it's a non-MEC. We require a certification from the allocator and a copy of the agreement, his agreement with the insurance company, so we have evidence that the allocator is well aware of the rules on limiting communication with the taxpayer to avoid owner control. We require certifications from the appraiser. And here we run into problems because not all clients like the way we do it. But we want the appraiser to certify to us that as of the date of the appraisal, which we want within an arm's throw of the date it goes into the policy, he was aware of all facts and circumstances involved with that company that were capable of being learned. If it's the client's company, he's interviewed the client. If it's just a non-public asset, we want to make sure he's made all inquiries that he possibly can. The reason for these certifications is, besides the fact that our malpractice carrier would not want to be the insurer of last result, but it's sort of our way of testing that people have done what they should do. So you have a validly issued policy and you've minimized the risk factor for owner control. In the Weber case was a 2016 decision. So we're 8 years after Weber. And the Weber case came up on an audit from 2005. I know for a fact that in conducting how we do these things consistent with this presentation, there have been a couple of inquiries to clients from Internal Revenue, but nothing beyond an inquiry that then went away. The learning I take from that is not that Internal Revenue loves me, but that the private placement variable life insurance industry is so large with the IDFs and people putting in cash and it compounding up, that their solution is going to be statutory modification. Any dislike under owner control simply won't get traction for the IDFs. So if you have a lot of cash, or you have a client with a lot of cash, I can't think of a better way to achieve Mr. Blattmachr's goal of letting this thing grow. And if you have someone who wants to be a little bit adventurous and has a little bit of consideration for owner control, then there's the offshore private placement involving non-public securities. Matt, I hand it off to you.
Bill, appreciate that. I think both Jonathan and Bill have done a really good job setting the stage for, why you might use private placement life insurance, and then ultimately, if you are, which is what I want to talk about next, okay, what do you do? What are some of the practical factors for, if you have a client or you yourself are an individual that, you think this qualifies for, how do you actually get this started? So the first thing I would say is seek really competent counsel and advice. Individuals like Jonathan and Bill, there are a number of others. Peak is happy to provide recommendations if that was ever something you wanted. Getting a room of advisors or counsel who really understand this space and can talk through the practicalities to really understand if this is right for you or a client is the first and best, I would argue, most important step. Progressing past that, there are some other things you want to consider, such as the jurisdiction and how this policy is ultimately owned. The jurisdiction, we start to think about things such as Jonathan referenced earlier, state premium taxes. Do we have proper trust statutes or LLC statutes, depending on the entity ownership, which is really most commonly done through one of two forms, either a trust or an LLC. So digging into this a little further, one commonly misunderstood piece of this planning is that each state has a premium tax. Most of us never see it. Many of us don't even know that it exists. It is just built into the premium itself. And when you think about the size of the policies that are typically purchased in private placement, this tax really can start to add up. There are really four best-in-class jurisdictions: Alaska, Delaware, South Dakota, and Wyoming, where the tax rates are most favorable. And you can either establish, again, these policies through a trust. You can look to have a trustee in those jurisdictions, or you can use an LLC with an LLC manager in that jurisdiction. You can look here at this chart. The rates for these taxes can be all over the map, anything from single-digit basis points to 300 basis points. So looking through this a little bit further, okay, this starts to add up. You can see some of the differences here. So for example, you take just a modest $100,000 premium, the tax can be, a couple $1,000s. When you look at something that's probably more realistic, a $10 million premium, we can be talking about hundreds of thousands of dollars in premium tax savings. So the jurisdiction really does matter when considering this type of planning. So ultimately, how would you take advantage of a jurisdiction if you or your client doesn't ultimately live there? So we start to talk about ownership structures. The first is ones where they're included in the estate, or they might be included in the estate, and that's really not a factor that's part of the driving issue in the planning. You can still get access to the cash values, you can still save on the premium tax, but again, that estate tax inclusion is not the most important, or is not a factor. You can purchase it through an LLC, through a revocable trust with a separate tax ID number, or an irrevocable trust. Again, depending on how the irrevocable trust is drafted, it may or may not be included in the estate. Of course, you can do the same thing where it is excluded from the estate. You can really, this limits you. You might not want to have direct access or need direct access to the cash value, but you do want the policy to be excluded from your estate. You do want that premium tax savings. And maybe there's even an element of asset protection that is part of the plan. You can look at an ILET, a dynasty trust, or an LLC or LP that really is owned by one of those two trusts. Talking about that LLC piece, so whether or not it's owned by a trust, the LLC you can use as a qualified entity owner. You can still take advantage of that low premium tax. So for example, in Alaska, past the first $100,000 of premium, it's only 8 basis points. It still qualifies the LLC. As a qualified purchaser, the LLC will look through to the member or the owner. The structure that we typically see is that it's a directed LLC in some way. So either there's a co-manager, so in this instance using Peak Trust Company as an example, Peak and another person or entity would be a manager, and really the other manager is the one that has the ability to really direct investments, or there's an investment advisor that directs those investments, and you just have a single manager, but again, that investment advisor is directing them. One of the benefits of an LLC could be a charging order protection. So for LLCs, one of the sole remedies under many of the states listed as preferential, the charging order is the sole remedy that a creditor could get in terms of some sort of ruling towards the LLC. And one of the issues with an LLC charging order is that you cannot force a distribution. So it's not something that is immediately beneficial to the creditor. Again, we looked at trust-owned policies, same advantage there. You can get that low premium tax, 8 basis points. You can have a variety of trust structures like we talked about, ILET, dynasty trust, revocable. You can have a variety of trust structures related to the trustee. You can have a sole trustee that has an investment advisor. You can have bifurcated trustee duties where different parties or people have different and distinct duties. And again, the benefits of a trust is that you can take advantage of potential tax and or estate planning strategy. To further articulate what's possible, you can also have an LLC that's held by a trust. We see this sometimes when there's an existing trust and there's a desire to purchase a policy. You can create this LLC and then have it purchased by the trust. And similar factors apply that we've talked about, whereas the qualified purchaser is either co-manager or they're the manager, but there's an investment advisor that directs them. That entity would, in using Peak as an example, would purchase the insurance and sign the paperwork in that appropriate jurisdiction, in this case Alaska. And the trust can be in a preferential or other jurisdiction. So, for example, it is rare, but we have seen where someone will use, say, an Alaska LLC, and they will use it inside of a New York trust. So ultimately, what does an entity like Peak help you accomplish if you're looking to purchase private placement insurance? So as an LLC manager, we would help accomplish essentially everything that's on this list. We would really help facilitate the purchase and maintenance of that policy. If we were a responsible party as a trustee, I don't have those listed out here because ultimately it's like, well, it depends on what the document says. But it may be or include many of these same responsibilities. It was a quick rundown of kind of the practical aspects for what you might want to look or think about if you believe private placement is a good strategy for you or your client. Again, I'd go back to the first thing I said, that appropriate and competent counsel in the room is the first and best starting point. With that, I can wrap up and we can see if there are any questions. Or Jonathan, Bill, anything to add before we get to questions?
Yeah, Matt, this is Jonathan. Let me mention some things. Life insurance, as I said, is not very well understood, and it is uniquely treated for tax, securities, and state law purposes in many, many circumstances. For example, people today are very worried about the tax-free step-up in basis with assets they own when you die. Well, normally, if you give an asset away before you die, people will say you can't get a tax-free step-up in basis. Now, my dear friend Mitchell Gans and I have come up with a structure where we think maybe you can, and you can read all about that in the September 2023 issue of the Journal of Taxation. But with life insurance, you don't have to worry about it. Typically, if you're acquiring a life insurance policy and you want to be sure that the proceeds aren't subject to estate tax when you die, you have it acquired by someone other than the insured, typically an irrevocable life insurance trust. It can be a grantor trust or not, it doesn't matter, because under Section 101, as Bill indicated, when the insured dies, subject to certain exceptions which are easy to avoid, there will be no income tax on the proceeds at all. So you get income tax-free receipt, and because the policy was never owned by the insured, it will not be subject to estate tax. So you get those tremendous advantages. Now, you do have to make gifts or have to make loans in order to pay the premiums. But if you make the trust a grantor trust and the grantor loans the money to the trust to pay the premiums, there will be no income tax friction and no gift tax friction, because you can use the safe harbor AFR interest rate under Section 7872 and loan the money at a very, very low rate of interest. And if you're careful about it, you can also just have the interest accrue, and no income tax will be paid on the interest, and there will be no estate tax paid either on the interest or on the policy itself or its proceeds when the insured dies. So I just wanted to mention that life insurance, and I don't sell life insurance for a living, so don't think I'm doing this to encourage you to buy life insurance. It's a very complicated product, but if you treat it the right way and you follow things that Bill has indicated to make sure that you're on the safe side of things, you can get tremendous not only estate tax benefits, but also income tax benefits to boot. avoiding income taxation on growth is, if you've got positive growth, is the number one way to build wealth. And life insurance probably offers more of an opportunity to do that than any other asset that's out there for investment. Well, let's go to some of the questions.
So one of the questions we have here is a hypothetical question. If Adam is an employee of a hedge fund, he works as an investor, the assets he has input on represent less than 5% of the total fund assets. However, he is not a partner, has no equity interest in the partnership. He does hold LP interests in this fund. Could he contribute these in kind to an offshore policy?
Let me take that because it's a variation of questions that arise. Could he? Yes, he could. Now, I'm assuming for purposes of yes, he could, that he would do an insurance trust where he was not a beneficiary, so he killed that prong. He would have to be willing to endure a risk factor that Internal Revenue would say that because you have influence or control over a de minimis 5% amount of the investment fund, you somehow are in control of the entire investment, and we can disregard the fact that you're not a beneficiary. That would be a case of first impression, but the answer is that he can do it, but he's going to have to live with the risk factor that, unlike an IDF where he was not running money, there is a risk factor under owner control.
Thanks, Bill. Another one is whether it's possible to 1035 exchange the cash value from an existing insurance contract to private placement. For example, if there are millions of dollars of cash value available and it's outside the surrender period.
Yeah, 1035 is going to work, but bear in mind that you're going to have to take the medical exam all over again. So assuming that, and that's going to affect the cost of insurance on the new product because you have an older insured. But putting aside insurability of the underlying insurer, the mere fact that it's going from non-private placement to private placement doesn't preclude 1035.
Excellent. Another one we have is whether or not acceptable diversification is determined at the time of investment, or if certain assets grow faster, is there a need for constant rebalancing?
No, there's no, well, you have to confront diversification whenever a new investment is made or there's an additional investment into an existing investment. If you set up if you get $1,000 as your initial premium and you put $200 into each of 5 different securities, that one security goes from $200 to $2 billion is irrelevant. But when you add 50 cents to that $2 billion, you just blew out diversification. So it's a test you do whenever you're making a new investment. And the issue is not whether other assets have grown in value, it's whether the mere fact of the additional investment that you're making precipitated blowing out diversification. Using my example, if you had the one asset that went from $200 to $2 billion, but you invested 50 cents in something altogether different, that doesn't impact diversification because that new investment was not going into the appreciated asset. It's every time the portfolio gets rebalanced, diversification has to be considered.
Okay, and it looks like another question related to diversification. With respect to diversification in 817H, in a separately managed account with the LP interests noted above the one investment, or would the test look through to the underlying investments?
If you have an IDF, you can look through. If you don't have an IDF, you cannot look through.
Bill, what does an insurance company charge to set up an IDF?
I don't know about any insurance company. I mean, some insurance companies just put their segregated asset account into an LLC and call it an IDF. I don't think that would get you much traction in tax court. But, you know, you got the independent major companies that are in the business of creating IDFs. I mean, that can cost, that could be relatively inexpensive. It could cost a couple $100,000. It depends on who you're using and for what purpose. But that's not really something that the insurance company is going to do itself.
And Bill, there are a couple questions about some slides that were in the presentation we didn't get a chance to talk much about, which is really some of the foreign compliance. So can you talk through some, practicalities there and things that some of the listeners would want to make sure that
I think as a practical matter, you shouldn't have to worry about foreign compliance, because you don't want to deal with a non-U.S. company that did not make a 953D election, because then you have a major risk factor. You don't have a segregated asset account, which means that under 7702 you're going to be taxed on all the income of the policy. So once you have no foreign account, no foreign insurance company, you yourself as the taxpayer don't have a reporting requirement. I think that's surplusage for purposes of the slideshow. We put that in there for people to think about. But once we restrict them to 953Ds or domestic companies, the concern for foreign reporting goes away. To be more precise, a Bermuda company with a PLR that says your regulations are now comply with state law, and we deem Bermuda to be a state for this purpose, I have nothing foreign there. It's all make-believe domestic.
And Bill, that's obviously good, because one of the things you want is flexibility, and you want to pay minimal fees, obviously, to how much. In fact, Bill, what does the insurance company charge each year to offer this IDF?
No. Let me talk through what the insurance company charges to run the policy, because they're gonna have a charge whether you have an IDF or not, and that can run anywhere from, say, 30 basis points to 125 basis points. If you had to pick a number, that getting it below 60 is unusual. If it's more than 60, that's unusual also. So your costs are going to be the vigorish, the M&A, the 60 basis points for running the policy, plus the pass-through of the COI for the pure death benefit, Jonathan. If I put in $1 million and in order to comply with 7702, I need a $3 million death benefit. I have $2 million. I need to have that one-year term insurance, and there's a cost of insurance. Obviously, as your investments grow, those numbers change. But those are the two major costs, putting aside setup costs. The two major costs are the M&A, assume 60 basis points, and the cost of insurance. If you wanted just to walk around and have some number that, for purposes of just talking without getting into specifics, for the overall cost coming out of the insurance company, I'd say $1.25, 125 basis points should cover everything. But that doesn't take the place of getting a specific proposal. I should have mentioned, but I didn't, that you want to get the illustrations from the insurance company on your specifics, in hand and examined and understood by the client before any money gets moved to the insurance company. But assume it's $1.25, Jonathan.
Thanks, Bill. And on the IDF question, there is a question from the audience about whether an independent RIA can run the funds in an IDF.
That depends upon someone has organized the IDF. If it's done by one of the two major organizers, they're going to be out in front on the whole thing, and one would ask them whether they could do it. Mostly, where you have IDFs, you find if it's a wealth advisory firm, the firm may sponsor one of their portfolios as an IDF, so it's the firm running the money, not the individual. I can't think of any tax reason why it's relevant, because all the rules restricting owner control, communication with the client will be set forth in the IDF agreement with the insurance company and the IDF agreement with whoever is running the money. So theoretically, I suppose there's no proscription. I just have never seen one done that way.
Thanks, Bill. And then last question we have, we've got about 3 minutes left, is for each of you, how do you approach advising clients who are considering PPLI as a strategy in their planning, and what do you think is most important that they consider?
Let me go first on that, because that happens on a daily basis. Number one, I keep a straight face and I say, I'll play poker with you. You show me your hand and then I'll put down my bet. So it's just my way of saying, look before you leap. So to me, when somebody says, I'm interested, you want to get all the facts, you want to get valuations, you want to get illustrations, you want to think through, is this going to be done in a manner where you're comfortable rendering an opinion, or are these people scaring you with what they want to do or how they want to finesse the rules? Also, we've had people come to us and say, well, I'm going to sell my business. I got 5 LOIs in there. Can I shove half my company into a policy? Putting owner control to one side. Once you have numbers out there at a high value, you're only going to be able to theoretically tax trap the delta between the actual sales price and the current value. So sometimes valuations, larger companies may have 409As with very, very high values because they're hoping to go to public. You have to see what is the current value, what is the reasonably anticipated future value, and is the effort worth the cost and risk factor. What you didn't ask me, but I'll volunteer anyway. Assuming somebody calls up and says, I need this whole thing structured, I want opinions, et cetera, explanations. How much should I budget on legals? Besides, you wouldn't say 75, give or take 25,000. You may have 20,000 for an appraiser if it's just cash into an IDF. Your whole cost factor may be down to 15,000, and you don't need an opinion. But getting all those operating facts squared away out front is crucial, at least from our point of view.
All right. Thanks, Bill. And that really concludes our time. Again, appreciate both of you joining us on this webinar. Bill, Jonathan, absolute pleasure to be here with you today. And thanks for everyone who's listened in or will watch this recording.
Thank you all for attending.